Today, a spotlight on Salisbury, postcode 5108. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Today, I want to share with you some research in our one-to-one series by looking specifically at a South Australian postcode, Salisbury 5108. Now, before we start, a quick reminder that this information is just based on my currently available information. It may change, it's not financial advice, and it is very much a point of time analysis. But we do use our core market model to search and obtain significant information about postcodes, including our household survey, which runs continuously and was up to last Tuesday. That information and all the other sources goes into our core market model, and that core market model then allows us to put information out through our industry reports, also on our blog, and also our one-to-one conversations. And from there, we can take the mortgage stress data, the price trajectory history data, the buying and selling intentions from the surveys, the migration data, and the broader economic information such as CPI, wages and employment, put it through our core market model, run some different scenarios, and then form a view as to what property prices may do. Now, this is just an estimate, of course, and it's based on information as of today. It will change. So we're looking at 5108, which is a suburb to the north of Adelaide. It's a relatively well-defined area, although it's worth noting that the northern boundary is defined by a river boundary there, the south side defined by roads. And just to locate it, it's a northern suburb of Adelaide. It is the seat of the City of Salisbury and in the South Australian Legislative Assembly electoral district of Ramsay and the Australian House of Representatives division of Spence. And here are just a few local shots. It's pretty typical with what you might expect to see, car parks and some commercial buildings. It's also got quite a significant rail bus terminus. It's quite interesting because the interchange there is on the Gawler line, 20.2 kilometres north of Adelaide Station, and there's a large park and ride car park. It makes it one of the busiest stations in the area. It's got some old buildings. For example, this is the quite famous St Augustine's Church. And if you go down Salisbury Arcade, it's pretty typical again with a range of shops. Away from the commercial centre, you then start to see some broader green areas. This is a local school. And as you move further out, you find a lot of low-rise, quite sprawly development of various ages. Some of them are actually in quite green, no-through road areas. Mostly, again, low-rise. Although we are seeing now the proliferation of smaller, high-density developments. And these often are aligned quite closely to the main roads and the rail line, so check the local area if you're looking at these. Might be more noisy than you think. There's also some redevelopment going on and a range of older style, high-density development, as well as residential and old age developments too. And there are still a range of green spaces and walkways. We'll mention those again later when we think about flooding. Now, in terms of the development zone, the South Australian data is reasonably understandable, although you have to look quite closely. And if you drill into the local area, you can see that there are areas zoned low density development, higher density development, some green spaces, and even a bit of industrial. So if you are going to buy in the area, it's worth looking very closely at the development plans. The other thing to look at are offences and crimes in the area. According to the latest data from the South Australian Police, there were 117 offences in the last year, broken down by various types. Doesn't really tell you that much, but more perhaps significant is this, that these are the highest crime rates across South Australia, and Salisbury comes in at number 10 with 16.81 incidents per 100 residents. So this is a relatively high crime rate for the area. The other thing to look at is flooding, and this is a flood map that shows essentially the risks that there may be in extreme flooding situations. And you can see that there are considerable areas to the north of the postcode and also around the edge to the south too. So my message would be that if you are looking to buy in this area, look closely at the flood information because it is actually quite important. Now, they said that flooding is an overflow of water. Well, there you go. Water courses in the City of Salisbury include the Little Power River, Adams Creek, Cobbler Creek and Dry Creek, and it generally flows west from the hills. The catchment of these water courses extend east beyond the city into the rural areas. Stormwater, of course, is defined as any rain that falls on roofs and collects, and there are events of flooding in the area as a combination of stormwater and riverine flows. And whilst there are no prescribed requirements relating to how councils manage floodwaters, stormwater management planning provides a mechanism for the management of floodwater in urban areas. So my message is simply this: if you are looking to buy in this area, check the flood plans. I also did look at the bushfire, and there was no zoning within this postcode, although to the south and west there were actually bushfire prone areas. Looking at the types of properties, there were for sale 23 properties in 5018 at the moment, a combination of houses and units. Here's a map showing their rough distribution around the centre of town. And just to give you a bit of a flavour, bit of a mixture, there's some units there, 149,000, a house around 350,000, a townhouse for around 280 to 299. These are indicative prices, of course. Another townhouse that's under contract, and then some smaller properties too. There's also quite a lot of property development going on, including the land for sale. But you soon get a flavour that whether it's apartments or whether it's houses, the price banding is relatively constrained. I'd also make the point, of course, that these are indicative prices. It doesn't necessarily tell you anything about what the price of settlement actually was. It's part of the problem in many areas, including this one, to try and get a good read on what fair value is. There are a few going for auction, but actually auctions are quite rare in the area. Now, in terms of sold properties, 22 properties sold in the last 8 weeks, and here's a map showing their distribution. And very little information about sold prices, of course, because the last asking price, if it's reported, is often in a range. Results from an auction, an apartment, another house, more houses. You can see there that the ranging is relatively constrained. Once you get up to $400,000, that's quite a lot of property for the price. And of course, comparing prices here with, for example, in Sydney or Melbourne, it's a world apart. And apartments for 120 to 130,000, pretty remarkably low. But of course, bear in mind also that incomes in South Australia tend to be more constrained as well. Now, looking at current price trends, this is for houses. Back in 2013, the average price for a house was $260,000. It went up by 1.9% in 2014 to $265,000. There was no change in 2015. It rose 5.7% in 2016 to $280,000. It rose 10.7% to $310,000 in 2017. In 2018, it fell 3.2% to $300,000. It rose in 2019, up 5% to $315,000. There was no change in 2020, and there's a small rise, up 3.2% so far this year to $325,000. That's the median price. Of course, there will be some variations based on individual locations and properties. That means that the average gain over that period is 2.9%, or after inflation, 1.2%. So really, very little growth over the past 10 years or so. If we then look at units, the story here is slightly less positive. The after inflation return is actually minus 1.3% over the period. The average gain, inflation apart, is 0.5%. Back in 2013, the average unit price was $180,000. It rose by 16% in 2014 to 2010, fell by 4.8% to $200,000 in 2015, rose 7.5% in 2016 to $215,000, rose 2.3% in 2017 to $220,000, rose 4.5% to $230,000 in 2018, and fell 28.3% in 2019 to $165,000, rose 3% in 2020 to $170,000, and no change so far this year. So $170,000 puts the median price below where it was back in 2018. If we then move to the overall postcode, the current listings are around 198, with 88 added in the past month. So the number of new listings are in fact rising. In May 2019, the listings were a lot higher at 345, and around 78% of houses, the rest are units. The rental vacancy rates are around 0.3% compared with 0.7% in mid-May 2019. There are around 20 vacancies reported currently compared with 42 back in 2019. Looking at houses, the gross yields on investment properties there are 5.4%. That's a pretty good return, about the same as last year. And the net yield is around 3.25 and falling just slightly. The rents for houses are rising, up about 6% in the last quarter, with a typical rent of $350 per week for houses. And the asking price for houses has moved up quite strongly, up 12% over the past quarter, with a typical asking price of around $340,000. But the average settlement is around 7% lower than the asking price. So vendors are being quite aggressive, but not necessarily settling at a very high price. The intention to sell is rising just slightly. Turning to units, there, rental gross yields are around 5.3%. That's a fall from 7.2% last year. The net yield is around 3.75% and is falling. The rents for units are flat at the moment over the quarter, around $260 per week. The asking prices are about 6% over the last quarter, with a typical unit price of somewhere around $250,000. And the average settlement is about 8% lower than asking. And the intention to sell is rising slightly. Looking then at the stress results, this is based on our surveys. There are around 16,100 households in this area. There are 7,400 borrowing, 7,058 renting, around 5,400 rental properties, and around 3,000 property investors. The overall financial metric for stress is at 38%, which is pretty typical of Australia overall. But within that, if you then look at home ownership, mild stress is very high. 79% of households with a mortgage are registering cash flow stress. That's 5,800. And there's a risk of default at about 3%, or just over 200, risking default over the next year. Though, having said that, renters are doing quite well. Very few are having difficulty with making their rental repayments, and property investors seem quite happy, given, of course, the high returns that we highlighted earlier on. I'm not surprised. So let's now look at price scenarios. We run 3 scenarios. The best case, that assumes the virus gets under control, the vaccination program runs very well, and the borders open next year. The longer term crunch is when we get more local infections and the borders stay closed for longer. And the second wave would be a fully fledged resurgence of the virus requiring significant lockdowns. In the best case scenario, over the next 3 years, we could see for houses a gross lift of about 9%. On the other hand, if there's a longer term crunch, it'll only be about 0.5% with falls over the next couple of years. And if there was a second wave, it could have a significant negative economic impact with a fall of around 8%. Translating that to real numbers, and we use the best case scenario because that's the one that has the slightly highest probability at the moment. 225,000 is the current benchmark price, and there is the possibility of a further small rise up to 343,000 through this year, and then a small rise of 2.3% and 1.1%, which would put the median price at around 355,000 in 2023. So slight growth, but by no means strong growth. If I then turn to scenarios for units, the same 3 scenarios, 8% is the best we can do over 3 years for the best case scenario. A very small fall for the longer term crunch scenario, and a fall down 5.5% over 3 years. These are cumulative numbers if there was a strong second wave. And that translates to the price of 170,000 median at the moment, moving up 4.1% through this year to 177,000, and then small rises of 2.3% and 1.6% over 2 years, which would put the unit median price up to about 184,000, which would mean that it's still below its peak back in 2018 of 230,000. So in summary, this is a postcode with some issues. It's probably one of the lower socioeconomic groups that we've looked at. The mortgage stress is very high. There has been limited capital appreciation in recent years and only a small potential for capital appreciation ahead. If you are considering purchasing in the area, I think it's really important to check out the local zoning. Also, check out the local flood maps because there are a number of properties with risk attached to them, and that would increase the risk of flooding, but also, of course, lift the insurance premiums. And also check out the local crime because the crime rate is somewhat higher than the number of other postcodes in and around South Australia, and that may be reflective of the types of people that live in the area. So I hope that's of use. If you'd like to have a discussion one-on-one about a particular suburb, feel free to reach for me by the DFA blog, and we can then complete the research. It takes a few days to do the research because we do go into quite a lot of detail, but it will give you a very good feel of how a particular suburb is currently faring. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.